Well, we kind of just saw this, but just to restate, between these methods, we saw that there's a split between uh, inventory and cost of goods sold. Okay, so we assumed that if prices are rising, right? If we assume inflation, that LIFO is going to be expensing the more expensive inventory that you purchase first. And so that's going to make your cost of goods sold higher. If your cost of goods sold is higher, that means you're going to make your net income low. But if this is the highest cost of goods sold, because cost of goods sold and inventory are kind of seesawing with each other, if this cost of goods sold is the highest, that makes our inventory balance the lowest. FIFO is the opposite. The cost of goods sold, since it's using the oldest, least inflated, you can say, inventory, like the least inflation impacted. Um, I guess you can just relate it to the milk, right? We bought it for $2, and then $2.10, and then $2.20. With FIFO, you're gonna cost this $2 layer first, right? So it's gonna end up having the lowest cost of goods sold, which makes the net income higher because you have less expense. But then since the cost of goods sold is the lowest, it's going to make your inventory balance the highest. Okay, so let's just check that against what we just did. So under LIFO, we had highest cost of goods sold and lowest inventory between the three. Let's just see. So LIFO had $14.60 is the cost of goods sold. FIFO had $14, and weighted average had $14.30. So yes, LIFO did have the highest cost of goods sold, and it's supposed to therefore have the lowest inventory. So $10 versus $10.60 versus $10.30. So yes, highest cost of goods sold, but lowest inventory balance was LIFO. FIFO is the opposite. It had the lowest cost of goods sold, but the highest inventory balance. And then weighted average was just in between the two. Okay, so that's essentially what this table is saying. Okay, specific identification varies because it's like you're gonna expense some high, some low. It's like you can't really say for certain because it depends on what specific items you sold. So you can't really say anything with specific identification. But between these three, the big assumption that makes this true is that prices are rising. Okay, if you had, what's the opposite of inflation? Deflation. Has that ever happened where prices go down a lot? Yeah, it definitely has happened. Okay, so in that case, this would all be reversed. Okay, weighted average would stay in the middle, but these two would flip because again, your oldest inventory would be the highest value, right? You'd pay $2.20 first, and then it goes down to $2, and then $1.80 as time goes forward. So that's like a deflation. So that would cause the opposite effect as this table. But it's usually mixed. We're seeing it in our world right now. What's been happening with oil prices? It's going up a lot, right? But before that, this is not the first time in history that oil has hit $110 a barrel. It's happened like several times, many times. And then it just goes back down and it goes back up. So, a lot of commodity prices are they fluctuate, especially oil. I guess metals, there's like, maybe some definitely have a trend of just like going up over time, but there are some that fluctuate depending on supply and demand. Okay. So, if it's mixed, then you can't really say between FIFO and LIFO what's going to be the case. If you have a constantly fluctuating kind of inventory, um, then it's going to be unclear which one is going to result in higher or lower net income.